Hertz Global Holdings, ticker HTZ, is currently trading at $4.95 per share, down 18 cents or about 3.51% in intraday trading. Now, if you just glanced at that number, you'd think it's just another bad day for a company that's seen nothing but bad days. But that drop is without a doubt the most misleading number on Wall Street today. That 3.5% dip isn't the story, it's the aftershock. The real event was yesterday. Yesterday, Hertz exploded higher by over 37% in one of the most violent short squeezes we've seen this quarter, all because the company did something nobody thought was possible. It actually turned a profit. The expectation for Hertz has been, for the better part of 2 years, that this company is fundamentally broken. This is the poster child for a bad corporate bet. We all remember the bankruptcy. We all remember the post-bankruptcy meme stock rally. And we all remember the headline-grabbing decision to buy 100,000 Teslas, a move that was supposed to signal a new tech-forward Hertz. The reality, as we learned, was a financial disaster. The repair costs for those EVs were astronomical. Demand wasn't what they projected, and the depreciation on those vehicles was crippling the balance sheet. The market narrative settled. Hertz was an overleveraged, mismanaged car rental company just waiting to bleed out, a permanent fixture on every institutional short seller's list. In fact, coming into this week, roughly 45% of the company's entire float was sold short. That is an enormous consensus bet that this stock is going to zero. Then, yesterday morning, reality hit. Hertz reported its Q3 2025 earnings, and the numbers completely contradicted the market's expectation of a continued collapse. The company reported adjusted earnings of 12 cents per share. The analyst consensus was for 7 cents. That's a massive beat. Revenue came in at $2.5 billion, also topping estimates of $2.41 billion. Most importantly, this was the company's first positive net income in over 2 years. The new CEO, Gil West, and his back-to-basics strategy, which the market had largely ignored, suddenly proved it had teeth. The 37% surge yesterday was pure panic from the shorts. It was a scramble to cover positions, as the core thesis that Hertz is structurally unprofitable was proven wrong, at least for this quarter. Today's 3.5% pullback, that's just volatility. It's profit-taking from those who rode the 37% wave, and it's the shorts likely trying to re-establish positions, praying this was a one-time fluke. So what did Hertz actually do? How did it pull this off? It wasn't through some new exciting growth story. It was by aggressively cleaning up the mess. The single biggest factor was vehicle depreciation. That metric, the main thing that was killing them, fell to $273 per unit per month. This is a stunning improvement. It's nearly 50% better than a year ago, and crucially, it's well below their own target of $300. They achieved this by doing what they should have done a year ago. They accelerated the sale of those high-cost Teslas and other underperforming vehicles. They pivoted their fleet strategy from buy right, hold right, sell right, focusing on getting better prices for their used cars by expanding their own direct-to-consumer platform, Hertz Car Sales, and partnering with platforms like Amazon. They stopped the bleeding from the EV experiment. At the same time, their operational discipline tightened significantly. Vehicle utilization hit 84%, a 7-year high for the company. They are running a leaner, more efficient fleet, getting more revenue out of each car they own. This creates a fascinating battleground. On one side, you have the bears, who look at the balance sheet and see a ticking time bomb. Hertz is still sitting on over $16.7 billion in total debt, with a very scary $5.7 billion of that being non-vehicle debt. This Q3 profit was great, but it's a small chick against a mountain of liabilities. They have $2.2 billion in total liquidity, which gives them breathing room, but they cannot afford to revert to burning cash. The analyst community remains skeptical. The consensus rating is a hold, with an average price target right around $4.90, almost exactly where it's trading now. They're not buying into the long-term turnaround story just yet. They see a company with massive structural burdens in a competitive, low-margin industry. On the other side, you have the bulls and the retail traders, many of whom are watching this on the Robinhood app or tracking SoFi stocks. They see a heavily shorted stock, 45% float, that just proved it can be profitable. This is the classic setup for a continued squeeze. They're not necessarily doing deep online investing analysis. They're looking at the momentum. They see a stock that was left for dead, like Tesla was years ago, showing a spark of life. This is where self-investing meets high-stakes gambling. The trading volume on Robinhood Stock Trading and SoFi Invest has been massive. This stock is a top trend as retail traders try to ignite the squeeze and battle the institutional short sellers, many of whom are using complex derivatives on platforms like Interactive Brokers. The Fidelity mobile app is likely lighting up with alerts as this stock swings wildly. This isn't a stock for a stable Fidelity IRAs account or a long-term Fidelity wealth management plan. It's a trading vehicle, pure and simple. So let's be clear about what Hertz is. This company is a legacy car rental agency. It rents vehicles to travelers at airports and to locals in off-airport locations under the Hertz, Dollar, and Thrifty brands. It's an old-world business that relies on travel demand, economic health, and most importantly, the extremely difficult game of managing used car values. Its bankruptcy in 2020 wiped out shareholders, and it only reemerged thanks to a massive influx of capital and a meme stock frenzy. The subsequent EV bet was an attempt to rebrand, to become something more than a boring rental company, but it was a catastrophic failure of execution. The new management, led by Gil West, seems to have accepted this. They have abandoned the flashy growth at all costs narrative and are focused on the nuts and bolts, operational efficiency, and fleet cost. Comment below with your take. Do you think this Q3 profit is the first sign of a genuine, sustainable turnaround for Hertz, or is it just a temporary blip before the $16 billion in debt finally crushes the company? Looking forward, the picture is incredibly uncertain. The bull case is that management is right. They've guided that they can maintain this sub-300 DPU depreciation per unit level through 2026. If they can continue to post profits, even small ones, they can start to chip away at their debt and prove the company has a stable future. The short squeeze could continue, forcing the 45% of shorts to cover and driving the price dramatically higher, independent of fundamentals. The bear case is that Q3 was a perfect storm. Used car prices might destabilize, travel demand could soften in a recession, or rising interest rates could make refinancing their massive debt load impossible. One bad quarter and the cash burn returns, and the insolvency narrative comes right back. This isn't an investment you make through a SoFi robo-advisor or a Schwab Intelligent Portfolios account. Those tools are designed for diversification, managing risk with Fidelity mutual funds or SoFi ITFs. This is the opposite. This is a highly concentrated binary bet on a single company's survival. This isn't a stock like Apple stock or Nvidia stock where you're betting on innovation and market dominance. This is a bet on a corporate turnaround, which is one of the hardest games to play in all of finance. It requires flawless execution from management and a lot of luck from the macro environment. Whether you're a seasoned trader using the Interactive Brokers trading platform or a new investor just starting an individual brokerage account with Fidelity, the one thing everyone can agree on is that Hertz will be one of the most volatile and closely watched stocks for the remainder of the year.